The next topic we have for you, it is investment strategy in the post-pandemic era. And telling you more, we have Zhang Xiaoyan, Xinyuan Chair Professor of Finance and Associate Dean at the PBC School of Finance, Tsinghua University, China. Prof, please.
Welcome to my talk. Today I want to talk about investment strategy in the post-pandemic era. My name is Xiaoyan Zhang, and I'm from PBC School of Finance of Tsinghua University in China. I'm very glad to have this opportunity to share my insights on where should we invest during this world of uncertainty. Talking about uncertainty, there is a very famous measure of uncertainty coming out of CBOE. It's called VIX. It's the volatility index. Right now on this page, I'm showing this VIX over January of 2020 up until now. So the higher the VIX, the higher the volatility is. What you can see over here is starting from January, the VIX is at around 15%. And then when the pandemic started, it went up to 80%. That's a time of higher uncertainty. People don't know what's going to happen. And then slowly it's going down. But later in the sample, up until November, you see a little bit of going up again. That's where the political uncertainty related to the United States presidential election. But overall, this year we have seen a lot of things. And there are a lot of uncertainties in the global capital market. Talking about global capital market, let's also look at their performances. Because I'm from China, I know China as an equity market pretty well. So I show here on the left the China stock market performance, and on the right the international stock market performance. So on the left, what do you see is if I put $1 in my account on January 1st of 2020, when the pandemic, you can see the gray area, that's the number of cases of affected individuals. You see the peak over there, that's where the market starts to decline a little bit. But the good thing is, up until July of 2020, the Chinese stock market has already rebounded back. And even now, you can see at the end of November, you can see the return is about 20%. I have to say, the Chinese stock market, even though it went through some of dropping at the beginning of the year, right now it's doing pretty well. You can see a similar case in the United States and in other emerging markets. So on the right-hand side, two indexes. One is the S&P 500 index from United States. That's the blue line. It goes down first and then goes back. The timeline is slightly behind the Chinese cases because the disease or the virus spread to United States about 1 month later or 2 months later than in the China mainland. And then when you look at the red line, which is the stock index of emerging market, it's going down first and then going back slowly. So there's a lot of, with the big drop and then going back, a lot of uncertainty. But overall, all those equity market indexes, they recovered right now. What about the correlations of the global capital market when we talk about stock market index? Why do I care about that? Because correlations among stock market indices, they are very important for international diversification. When the pandemic was in place in March and April, you can see the correlation start to increase up until 50%. That's where international diversification may not be as effective as you want to be. You want to diversify, you want to look at different assets, but when the correlations are very high, the diversification becomes ineffective. Okay, what about other assets? When we think about during this year of uncertainty, where should I go? Should I go to the stock market or should I go to the bond market, the commodity market? So here I show you the data as well. On the left, I put the stock market from China as a benchmark. On the right, I consider several alternatives. The green line at the bottom is the price of the crude oil. So this year doesn't seem to be a very good year for investing in crude oil. A lot of volatility and the return is negative. And then we have this yellow line, which is currency. Here we're talking about US dollar index. So the dollar value at the beginning of uncertainty, it actually went up, but then it goes down slowly. But overall, US dollar seems to be a good instrument for insurance purpose. It's very stable. And we also have this red line, which is the value of the gold. And during time of uncertainty, people want to invest in gold, and the gold price did increase for a majority of the year. And then we also have the blue line, which is the bond return index in China. It's very stable. So what I'm going to say from looking at the data, I have been showing you many of the figures you probably have known already. First, there is a lot of uncertainty. Second, the stock market first dropped and then came back. And third, you might think about, investing bond, investing gold, investing strong currencies like US dollar to protect your wealth, and that would work. But the oil market was not doing very well this year. Okay, talking about all these investment choices under high uncertainty. Here I list all the possible choices because, back in April when we were looking at the uncertainties, we don't know what to expect. Should I be selling all the stocks? Should I be investing in bond market? Should I move on to the commodity market? The results I mentioned here, there are a lot of costs here. First, there could be high transaction cost. And second, you don't know when to exit the market and when to enter the market. And third, the performance might not be persistent. The most important thing, you don't know what's going to happen in the future. So here is my first insight for everybody. Number one is, where should you invest your money? That depends on your risk preference. And number two, whether you have outperformance depends on your knowledge and your ability to process information. And number three, you should be rational, especially during high volatility, high uncertainty period. Now, today we're in the festival of FinTech, right? And the very interesting and important question to ask right now is, can we do something using FinTech? And the answer is yes. I'll show you several cases. And those are research from Tsinghua University. Again, I'm at the PBC School of Finance. I have been working with my PhD students and the postdoc and the research staffs to work on, can we use FinTech to improve on our investment decision making? Let's start from the first experiment. It's called market timing. What we do here is we look at past signals, let machine learn when to enter the stock market, when to get out of the stock market and invest in the bond market. So what you can see over here, I'm showing you the data from January to May. So the blue line, varying much, that is the original stock index performance. But if you use the signal we use, which is based on uncertainty and a lot of macro variables, you need to exit the market at the end of February. See, if you do that, that's the red line. If you exit the stock market at the end of February, you would avoid the downside drop in March and April. But that's only the first part of the story. And the first part story tells us market timing can be done during uncertainty times. But I also want to tell you the second part of the story. The second part of the story is, using the market timing strategy, you were able to avoid the drop. But does it tell you when to come back to the market? So here in this picture, I show you two lines, but up until November of 2020. Now, the market timing strategy is still working well. The only problem is, see, the market timing strategy, the purpose is to minimize volatility. I did minimize volatility, but because I still exit during May and October and September, I also miss the high volatility but good upper running period of the stock market. So if you are going to use market timing strategy, you have to be very careful which one. You want to avoid the bad uncertainty, but you want to keep yourself in the good uncertainty because you will be rewarded. That's the first experiment. Market timing tell you when to exit the market, which help you to lower volatility. Our second experiment is to use machine learning to do stock selection, which is more exciting. So what I have here on the left, I'm using Chinese stocks as example. On the left, I have thousands of stocks, and every single stock, I would have like hundreds or thousands of signals of this particular stock. So what we do, we put all these signals into the machine learning toolbox. We have many machine learning methods, and then it output the optimal allocation of investments. Did that work in China? Did that work during this uncertain year of 2020? Well, I'm very happy to show you the performance over this year. So this is a working paper we're doing. So we have the AI strategy. It's a machine learning strategy. We call it artificial intelligence strategy. And we compare with the market index, which is the CSI 300. Annualized return for the year 2020, our return is 82% with a volatility of 29%, a Sharpe ratio of 226. I have to say, at least on paper, our machine learning strategy for stock selection has been phenomenal. I mean, it's working very well, but you have to keep in mind, this is on paper. If you take it outside, it might not work so well. You have to do a lot of adjustment. Talking about taking it outside, we are not the only ones using machine learning. Here, I'm showing you, in China, there are a lot of groups, lots of professional investors here. I'll tell you, I put them into 4 different groups. There are mutual fund managers, mutual fund performances, the blue one, mutual funds. The green one are hedge funds, and the orange one is quantitative funds, and the red one, again, is the stock index. What I want to tell you is who use machine learning or FinTech to improve on their portfolio strategies. Those are mostly actively managed funds, but I can tell you quantitative funds, they use a lot of machine learning and FinTech to improve on their investment strategy. So what's the return for the past 3 years for this type of fund? On average, 10.61%, which is 3% higher than the stock market index. We are not here, our team, we are not the only ones using machine learning to improve on the performance of investment. There are a lot of people doing that outside. You may know that in China, the fund industry is picking up so quickly. Over recent years, there are thousands of hedge funds and thousands of mutual funds. So the last experiment we do in our school is to see, can we use machine learning to actually select fund managers? See, this is the last experiment we do. We use machine learning for selecting hedge funds and mutual funds, and then we can form funds of funds, or FOF. And do they work well? Here we go. On the left, we have annualized return for the year 2020. On the right, I have annualized volatility of 2020. For the blue ones, mutual fund FOFs, their return is 13.2% with a very low volatility of 6.7%. And if we're talking about hedge fund FOFs, their return is about 17% with annualized volatility of 7%, which says, you know, in China or maybe in the global market, using machine learning to pick up the best performing funds seems to be very promising. They have low returns. Well, sorry, they have very high returns. They have very low volatility. Okay, I'm going to stop right here. So what did I talk about today? Number 1, 2020 is a year of challenges and opportunities. The challenge is We have a lot of uncertainties in the market. Some assets do very well, some of them do not do well. And during this time, people tend to panic and don't know where to put the money. So I focused on a few experiments we did at PBC School of Finance with the Xinyuan FinTech Center. What we show is machine learning, FinTech provide a lot of new perspectives on investment. It helps to select the stocks, it helps to select funds. Well, thank you very much for watching.